Hi, let's work on some applications on yield to maturity. So this business issued bonds 5 years ago at $1,000 par value. These bonds had a 25-year lifetime span, and annual interest payment or coupon payment was 15%. That means 15% applied to 1,000. Investor would receive $150 per year. This return was in line with the required returns by bondholders at that point in time. And this is how was split in the three factors. Assume that 5 years later, inflation premium is only 3%. So now, instead of 6%, here we have 3%. That means the total return is going to go down by 3%. 6 minus 3, 3%. So that's going to total return is going to be 12%. That's the new yield we are going to use when calculating the new present value of this bond. And the bond has 20 years remaining to maturity. That's another one that we are going to use. N equals 20. Compute the new price of the bond. So N equals 20. Interest rate, we are going to use 12%. Okay. Because the inflation premium goes down from 6 to 3%. But my coupon payment is still 150, which is my investment at 15%. So now if the current bond are issued at 12% instead of 15%, intuitively, if I want to sell this bond, the price is going to come up above 1,000 because I have a more valuable investment, 15%, rather than the new bond 12%. So let's calculate the price of the bond. We take 150, that's a coupon payment, but this is where they have the explanation on how it's the new one. Use this one to calculate the price of the bond. I just explained 12%. And then you take 150 annuity payment using Appendix D, N equals 20 years left over, interest rate 12%, that's the factor. And then you take the principal payment, 1,000, Appendix B, N equals 20, interest rate 12%. And that's the amount. So then that's the amount here, then you add up these two values, 1 and 2, and that's the total price of the bond. It's above 1,000. Let's see if we find another one. Well, the next one is the same with different numbers. You are going to work. I'm going to assign some individual work for you. And let's see what we have. 15. Effect of yield to maturity on bond price, a different example. This business issued bonds 10 years ago at $1,000 per bond. These bonds had a 4-year lifespan, and the annual interest payment was 12%. This return was in line with the required returns. This is how it was when that bond was issued. 10 years later, so that means that I have 10 years, 30 years remaining to calculate the new price of the bond. That's the one we are going to use for N. Due to good publicity, the risk premium is now 2%. You see, risk premium used to be 5, now it's 2. In reality, the risk premium goes down for any business corporation issue bond when the industry becomes more stable, the economy is doing well, or this particular business is very strong, is increasing a lot, and there is less risk associated with this business failing and for investors losing their money on bonds. So now if the risk premium is 2, we replace 5 by 2, the total yield to maturity is going to be 9 instead of 12. And when we calculate, that's the one we are going to use in present value calculations. Again, because I have this one is less than my original investment, I expect the price of the bond to have a value of higher than 1,000. And then I do the specific calculations. So let's see how much was the interest payment was 12%. This one doesn't change, stays the same. So that means I receive $120 per year. You see, $120 I use this one, interest rate 9%, and equals 30 years remaining to maturity. And then I have Appendix B, I have 1000 times, I use these numbers here, and I have $75 present value, and then I add up these two values to have total price of the bond. So that was another application, and then I'm gonna assign some similar ones for you to work on to feel more comfortable. 16. And let's see what's this one about. Let's do one on semi-annual analysis here. Okay, so you are called in as a financial analyst to price the bonds. $1,000 value, interest rate 10%, which is $100, which is paid semi-annually. That means you receive $50 every 6 months. Okay. See, that's the one that's going to be using calculations. The yield to maturity on the bond is 10% annual interest. So we use market interest of 10%. Okay. And there are 15 years to maturity. Compute the price of the bond. Well, before we do the calculation, we have to do the conversion. So number of years is multiplied by 2 because every year we have 2 payments. It's semi-annual analysis, so n is going to be 30. Interest rate of 10% is divided by 2 because that's per year. We get 5% every 6 months. So those are the numbers we use with Appendix D and Appendix B. Okay, and I receive a coupon payment of $50 because my annual interest rate is 10%, $100 divided by 250. And then I do the usual calculations here. Appendix D, present value of coupon payment. Appendix B, present value of the principal. Add up the numbers, and I am close to 1,000 basically from semi-annual analysis. Now in B, suppose that with 10 years to maturity, if yield to maturity goes down substantially to 8%, so now that's the one that we are going to use with appendixes. Instead of 10%, 8%, but I have to do the conversion again. 8% divided by 2, 4% every 6 months. And 50 stays the same, but I use 4 instead of 5. That's the only difference. Instead of 5, I use 4 here. I divided by 2. N equals still 20. Does it say, well, we have a change in with 10 years to maturity, so that changes too. Instead of 15, we have 10. So 10 times 2, 20 years. 8 divided by 2, 4%. And then we use those calculations, Appendix D and Appendix B, and I have present value or price of the bond, $1,135.50. It's expected to be above 1,000 because now I am 8%. It's below my original bond coupon payment of 10%. So I'm going to ask you to work on more problem solving similar to those, and I'm going to work on new recordings for stock valuations and different type of stocks.